Okay, before we jump into this week's market outlook, under sector studies, all the way down under communications, if you click here, there is understanding telecom. It's almost 3.5 hours. It's about an hour of information that you're going to need to understand the telecoms. And then it's a walkthrough at a high level of Verizon, T-Mobile, and AT&T. Let's just hop back to our sector studies here. And you can see all the sectors are up, and it tells you how many hours of videos are in each sector. So financials is probably the one with the most information, almost 16 hours of videos in there. Materials, 6 hours. We have consumer discretionary, almost 6 hours of video in there. Top down sector, almost 9 hours. Energy sector, 2.5 hours. Healthcare, pushing up on 5 hours here. In communications, we're sitting at 4 hours. I will keep adding to these sector studies. My goal is, over the next how many years, is to have a video up on every sub-industry. That's a lifetime project. That will take me years to do. There are 160 some sub-industries, but the applied level has no expiration date. So it's not as if you have to renew every year and you have to start thinking, well, how many are you adding each year? I will add what I add when I add it at the speed that I can add it, but there is no expiration. But that doesn't mean the price won't go up. I mean, inflation happens all the time, and Amazon is not going to stop charging me more and more and more each year. So let's just jump right in now. This is the market outlook, Sunday, March 10th. Going to start with the jobs report from Friday. And I know this is a busy screen. Lots of information that I wanted to pull out of this one. So let's just start contrasting the household with the establishment. Household shows a loss of 184,000 jobs. Establishment, a gain of 275,000, with government adding 52,000 of that. The categories, healthcare and services, added almost 91,000. Leisure and hospitality added 58,000. Leisure and hospitality, typically low-paying jobs. Healthcare and social assistance does not increase potential GDP. So it is GDP without the investment characteristic of GDP. It does not increase potential GDP. From the household sector, participation rate unchanged at 62.5%. Unemployment up 324,000. This is an important number, 6.458 million. This is the highest since January 2022. So unemployment jumped up and then it started coming down, right? And if you look at the chart on Fred now, it's starting to do this at the longer end of the curve. Well, you can't really pay attention to this. You got to just sort of take that out. So if we go pre-pandemic, it's the highest since January 2019. Unemployment rate just a sliver away from 4%, 3.9%, up from 3.7. The lesson high school lost 89,000. High school gained 563. Lesson BA gained 158, and BA down 309. And all of this is for 25 years or older. The 25 to 64 gained 328. 16 to 19s lost 96, 20 to 24 lost 370. Sort of more cracks in the plaster here. Full-time down 187, part-time up 51. So from the household side, a loss of 184, nothing going on the participation rate. An increase in the number of unemployed to a pre-pandemic level of January 2019. Unemployment creeping up, and jobs more basically skewing part-time and less full-time. From the establishment survey, we've already gone through this. Average weekly hours up 0.1 to 34.3. Average hourly earnings up 0.145% to 34.57. That is 1.75% annualized. Average weekly earnings, because you've had hours going up and earnings going up, average weekly earnings are up 0.437 or 5.38 annualized, but this is what you're paying. It's just that they're working more. So to see how that looks, This blue square, the inside square here, is average weekly earnings. Average weekly earnings is made up of average hourly earnings and average weekly hours. We saw average weekly hours increase a little bit and average hourly earnings increase a little bit. The red is because more people, because everyone's working more hours. The purple is because everyone's getting paid more per hour, and there's your interaction effect. That is the extra hour at the extra pay, your interaction. So you can see that the square is larger. So if we're looking for power on retail sales, we look for average weekly earnings, which is a function of what you get paid per hour and the number of hours you work. If you have average weekly hours dropping and average hourly earnings flat, you would have a decrease in average weekly earnings, would expect the consumer to be weaker. Revisions, this is important. Remember last month how strong it was, and TLT took a nosedive right away, bond yields went up. Well, what if these numbers had been released instead? January was 353, now down to 229. And I believe there was a downward revision to the average hourly earnings as well, which means the wage inflation was not what it was when it was first reported. That's a drop of 124,000 on the revision. December also revised down another 43. And again, with the establishment at 275, 52 was government alone. Looking at duration of unemployment for those who remain unemployed, October, November, December, January, February, and this is February 2023, year over year, 38.3 to 36.1, that's less than 5 weeks. So there are fewer of the unemployed that are less than 5 weeks, but it has been ticking up. 35, 33, let's be able to write on this, 35, 33, 34, 6, 34, 9, 36, 1. More recent layoffs will lift that number. 5 to 14 weeks, last year was 30.7, still hang out roughly 30, and 15 weeks are over 31.1, now 33.8. So it is skewing towards longer duration year over year. All in all, it's a report that gives the Fed permission to cut rates, especially with the revisions. I think the Fed can take the jobs report and say, well, okay, it has been saying it's been coming into better balance. I think it's still moving in that direction. So I think this is speaking to rate cuts. However, we get CPI in 2 days. Money market rates all still well behaved, anchored with the Fed funds at 5.25 to 5.5. We have a bull flattener on the long end of the curve. Bullish because rates are going down. When rates go down, bond prices go up. That's why we call it bullish. And flattener is anytime the curve keeps doing this, right? The more inverted it gets, you may say, well, it's getting steeper as it's inverting. That's actually getting flatter. It gets steeper when it travels this way. It gets flatter when it travels that way. We have a bull flattener, at least week over week on the long end of the curve. Still looking at curve inversions, almost 600 days on the 2-year to the 10-year. Don't know if that's going to set a record or not. 484 on the 3-month to 10-year. I would have to go back and look at what the longest duration was. I think it was 600 and some odd days. Or actually, now that I think about it, it might even be in the 900s. I'm not sure. Next week, I will see what the longest duration was, because I think we should be looking at these in relation to the longest duration now. 599, 484. Canada's 2 to 10 inverted 72 basis points. The Bank of Canada did nothing, didn't move. The jobs report for Canada added jobs, but the unemployment rate, like the U.S., ticked up as well. It was generally weak other than the headline number, just generally weak, which does give the Bank of Canada permission to cut rates as well. The 3-month to 10-year inverted negative, inverted 161. 30 billion of runoff from QT, sitting now at 6.926 trillion on the balance sheet, or 6.926 trillion attributed to the securities holding on the Fed balance sheet. Full balance sheet is 7.53 trillion, was 7.56 trillion, down 28 or almost 29 billion. But this was a runoff of 30 billion, so outside of securities runoff, the balance sheet increased by a small little $1 billion there. Money market funds increased again, 18.65 billion. Retail increased, institution increased. Both increased their government holdings. Retail increased their prime, and institutions decreased their prime. Last week, there was an increase. I said we can't really read too much into that because that was for February 29th, end of month. But retail continues to increase, institution continues to increase, but this showed a decrease. So there just might have been positioning for end of month in that category. FOMC, March 20th, 10 days away now. Next week, I'll talk a little bit about what we can expect because we do have SEP projections coming up with this one, and some expectation of talking about QT. Big week this week, US CPI in 2 days, US PPI in 4 days. You also have a 10-year auction on Tuesday and a 30-year auction on Wednesday. This is risk event for yields here. This is big risk event for yields here. So duration has got a really tough week ahead of itself. Unchanged on the probabilities. I just read the 4% to be hedging, and that the true probability here is nobody is expecting anything. For June, it is increasing a bit. There is some probability sneaking in for the first rate cut to happen in June. So if we look at one rate cut by June, you're looking at 57.4%. Well, you can add it to the 15.9 as well. You're over 70% probability that there'll be a rate cut by June. 2 or more, 15, almost 16% versus 10.5%. I think the jobs report really helped out. We get a benign inflation report, and especially revisions for last month, bringing it back in line to expectations. Bond yields could rally. Bond prices could rally nicely. Bond yields can retract a bit more on that bull flattening. The probabilities for June would increase more. Effective federal funds rate still sitting at 5.33, still giving a lag of 75 basis points. If we think about a 12-month lag on the effect. Reverse repo up $3.5 billion week over week to $444 billion from $441. But on March 7th, it did hit a new low of 436 on March 7th, and then just bumped up on March 8th, which is common going into the end of the week, going into a weekend that money would park there for the weekend. 436. I looked at January 2nd to March 8th, all the way to March 8th, January 2nd to March 8th. I looked at the RRP balance here and the RRP balance here, and I calculated what the daily runoff was. And then I took that number, I divided 444 by that number to get the number of days to get to zero, right around July 3rd. If it continues at this rate, which it's a naive way to do it, it's just a linear interpolation of it, it's naive. But if the pace of runoff continues going forward as it has since January 2nd, we would expect that by July 3rd, with some variation, right? So we look at it, there's July 3rd. There'll be some variation, so there'll be some distribution around that. I would say that that's probably my best guess as to the center of the distribution is July 3rd. TGA, 760 billion, down 7 billion. Yellen says the target on the TGA is about 750 billion. They're sitting in and around their target. It is not underfunded, signifying potentially an increase in treasuries. It's not overfunded. So not much to read in there. Reserves up almost 80 billion, 3.6 trillion. If we add the reverse repo and reserves, and we take off what I think is the ample reserves number, or at least the middle of the distribution for that number, 2.5 trillion, you get 1.565 trillion that we can continue to run off at 95 billion a month. That is 16 months before you would have to completely just stop it. I don't think they want to just stop it. I think what they want to do is go from the 95, drop it down a bit, drop it down a bit, drop it down a bit, taper it out. They also said that that allows them to continue balance sheet runoff longer than they normally would. Looking at real rates have all gone down. We have an upward sloping real rate curve. Not much to see here, sort of well behaved, not big moves. For the Fed funds futures, let's just go right to here, Q2. By the end of Q2, we have implied rate cuts of 16.5, Q3 another 31.5, Q4 another 35.5, for a total of 83.5 basis points versus 72 last week. So if you were long the December Fed funds futures, which last week I said I would be comfortable being long the Fed fund futures with 72 basis points of cuts implied, you're already up 11.5 basis points. I think the rate cuts are more than 3, so I think this could move to 100. It all depends on CPI. In 2 days, it's a big risk event for any interest rate or any duration that you have. TLT, thank you very much, 1.33%. SPY pulled back 0.26, and that was Friday alone, which brought it negative for the week because on Thursday, SPY hit another all-time high. A whole bunch of things are hitting all-time highs. I'll talk about that soon. No implied volatility for 13 weeks. Again, on TLT, 26-week is dropped from 3% to 2% and 52, 7 to 6. I still think selling the 94 and 93 puts on any weakness makes a lot of sense. And again, we have Tuesday CPI, so if there's any weakness and TLT gets pushed back down to the 94 to 93 level, I think selling puts there still makes sense. Mortgage rates pulling back 6.88, down 6 basis points week over week. It was looking like it was going to threaten the 7% barrier. The 10-year Treasury down 16 basis points over the same period of time versus the 6, so the spread increased by 10 to 279. I think 309 was the record for this particular cycle. Here is, I think, a 5-year. Yeah, this is a 5-year of the 10-year U.S. Treasury versus MBS. MBS are in prices. 10-year Treasury are in yields. You can see as yields dropped, MBS increased, sort of went sideways. And then you had the increase in 10-year yield, the drop in MBS prices. We've sort of been going sideways, So if we think the 10-year yield is dropping, MBS prices will rise. Looking at OAS, unchanged. I had to check the numbers again to so many categories unchanged, changed by just a little, but there's CCC again, down 12 more basis points. The biggest winner in terms of if you were long credit, CCC was your biggest winner. Issuance year to date, 31.1%. Here's January, here's February. This is February of last year. January rolls off, but look at the size of these. To put it in context, investment grade for February, 201 billion. Last February, 156. So that's an increase of 33% year over year. High yield was 14 last year, almost 28 this year, 27.4, 100% increase. What is interesting is if you go back to last year and you look at yields on investment grade, they're about the same. However, high yield has contracted on average by about 50 to 60 basis points. For January, February of 2024 versus 2023 and 2024, high yield is about 50 to 60 basis points lower in its yield. Total outstanding as of Q4 2023, 10.8 trillion. I think that is an all-time high for the amount of corporate debt outstanding as well, 10.8 trillion. And of course, you have to add January and February minus any redemptions, any principal redemptions that have been paid, which I don't have the data for that. But I would say at those levels of issuance, that probably far exceeds the redemptions. Question has to be asked, what are they doing with all this debt? So it's either going to be debt because the balance sheet, the assets are expanding, and there's a certain debt equity ratio that companies target. So if you're going to expand your assets by $1 billion, you're going to support it with 500 million in debt, 500 million in equity. Or is it that you're simply just raising your leverage by buying back shares? Is this debt CapEx related, or is this debt share buyback related? If it's share buyback related, well, then that's another driver of equity markets higher. If it's CapEx related, I haven't seen that in at least the companies in which I read the 10Ks. I just finished with all the telecoms that their CapEx spending this year is lower than last year. For all of them, it's lower than last year. And you're seeing a lot of that as well, that the CapEx in other sectors are lower. It could be for acquisition. I am seeing a lot more acquisition in the energy space, especially companies that are situated in the Permian Basin. That the larger companies are buying the smaller companies, and in buying the smaller companies, this is interesting, shutting down certain wells that would not qualify as producing enough oil for a publicly traded company, thereby reducing the amount of oil that will be coming onto the market. So consolidation and supply management at the same time. I still think, as I've said before, I know I'm going on a tangent here, but sometimes thoughts come to my head. Oxy, which just acquired recently, I think in the last couple of quarters, acquired a company in the Permian. I still think Oxy is great for selling 57, 50, or 55 puts on any weakness at all. So, you could have, this could be CapEx over here, and I'm thinking CapEx outside of acquisition. It could be acquisition, or it could be share buybacks. Right, and it's probably a combination of all of these things, but I'm going to downplay the increase in CapEx the most. I think it's either acquisition or share buyback. Mortgage apps left one little point as an orphan, standing on its own here. As of February 23rd, up 9.7%, and last week mortgage rates were in the 6.9% category. So that's a 9, that's a 6, there we go, in the 6.9, and you still had an increase of almost 10%, but that comes on several weeks of just negative growth in mortgage apps. So your mortgage apps might have dropped to a point where any small bounce, just because the base is smaller, made the increase appear larger. Okay, got to talk about NVIDIA. If you were watching on Friday, you have a taste of what happens with momentum. Momentum breaks fast, very fast, because if you get the Momo crowd in there, the momentum traders in there, they're short-term traders. They're 5-6 minute traders, that's it, and they bail. So you end up getting very volatile stocks. And what we saw on Friday was an example of what happens when you chase momentum. Now, that's not saying that NVIDIA is over. It's just saying that you have this momentum crowd in there. Now, they're not going away either. None of them are going away. They're going to be back Monday, and they're going to play the stock again. But it hit an intraday high of 973, closed at 875. That's a $98 drop from the intraday high to the closing price. After hours, it continued to trade down to 851. So from 973 down to 851, that's a $122 drop. Closing at 875, but then still trading down to 851 after hours. You got another $24 downside. Is that a preview of where Monday will open, and will Monday continue? Some other interesting things going on. This hit an all-time high, 973 on intraday, and on your closing price at 875, closing for the week. On a weekly closing basis, that's another all-time high. You had your closing the day before above 900 for all-time highs. Bitcoin broke 70,000, sold down to 69,030, also hit an all-time high closing, I think, on Thursday. Gold broke 2,200 briefly, sold down to 2,186, also another all-time high. What's going on? Bitcoin, gold, is that related to anything going on here? Is just momentum flowing in? Is money flowing in somewhere? If we look at where, let's just deal with gold right now, and then I'll talk about what could be driving Bitcoin. About half of all the gold shipments, I think so far this year, half of all the gold shipments have gone to China and Hong Kong. And I think that's a function of their property sector. If we look at the property sector, by some measures, I think one government official said there's enough empty homes for 3 billion people. 3 billion people. China doesn't have 3 billion people. But more realistic estimates are that there's 10 years of supply, counting all the cities. And they structure their cities into first, second, and third, with third being the smaller cities, number one being the bigger cities. Supply is more reasonable in the larger cities, like 9 months. But you're talking like 30 years by the time you get to these level 3 cities, these smaller cities that on average, 10 years to clear the market, 10 years. Culturally, housing has always been a big thing in the Chinese market, is to put your money into housing and to own housing. And if that is becoming a lost generation, 10 years, what would you do? Gold? There you go. I think Bitcoin is banned in China. Somebody can advise me on that because I'm not in the Chinese market. I think China has banned Bitcoin. But that does not mean that there is no way to own Bitcoin in China. It's just that they banned it. I think that gold would seem like the natural thing to move to. So this could be a bigger function of the property market in China when you have half of the gold shipments that went to China and to Hong Kong. Bitcoin, what's going on there? All-time high closing Thursday was 69.3, somewhere around there. I'm looking at the futures price now. I'm not the spot, but 69.3 on the front month futures. Interested in the ETFs because there have been some ETFs launched. So a quick Google search tells me, and I don't know how accurate this is, 9 ETFs launched. 9 ETFs launched since January, since it was approved in January, collectively bringing in 52 billion. The biggest one is the Grayscale ETF. And then Blackstone has one, ticker IBIT. And Grayscale is it's BTC, well, G, Grayscale Bitcoin BTC. The other reason could be the halving in April, or the upcoming halving. H-A-L-V-I-N-G, H-A-L-V-I-N-G, and that means that it is the reward that Bitcoin miners make gets cut in half, 50% of what it used to be. And this happens every so often, that the reward gets cut in half. Why would this happen? And this is expected to continue so that you never run out of Bitcoin to reward miners. 21 million is the fixed amount of Bitcoin. But you have to incentivize miners to process transactions. Well, if you keep rewarding them, at some point you'll hit 21 million, then who pays for it, right? So if you use the math of Zeno's arrow, I'm not sure if you have ever heard of Zeno's arrow. Any computer science student will have heard of Zeno's arrow. I think you're introduced to that pretty much in the first year. And when I first was introduced to it, I thought, well, what a silly statement to make. I challenge anyone to stand against a wall and let me fire an arrow at them. I guarantee you it'll hit them. But the math is useful for Bitcoin. So what it says is, let's take a distance and let's fire an arrow. And Zeno argued that the arrow would first have to get halfway. And then it would have to travel halfway to its target again before it hit its target. And before it hit its target, it would at least have to travel halfway, and then halfway again, and then halfway again. And his argument is it would never hit its target, which is ridiculous, right? What you have to have is a fixed target. Now, the arrow can go well beyond that. So he was just using an analogy. So if you never want to run out of Bitcoin for miners, if you continue to have the Bitcoin, you'll never run out. So at 10.5 million, you have it. That means there's only 10.5 million to go. So the next 5.25 million you then have it again, which means there's 5.25 million to go, and you keep having it, having the reward, which means you'll never run out. Well, when you have it, because the cost of processing the transaction remains the same, the value of the Bitcoin would have to double each time. That's the logic behind the math, is you'll never run out if you base the halving on Zeno's arrow paradox. You use the math of Zeno's arrow. You'll never run out, and to incentivize miners, the price would have to go up, otherwise you can't process transactions. So that's the halving. And the belief is that with the halving coming in place, the price of Bitcoin would naturally rise. It would double. So the thinking is maybe 80,000. Even 100,000 is being thrown out there. Let's go back to NVIDIA. Now that we've talked about BRR hitting all-time highs, gold hitting all-time highs, NVIDIA hitting all-time highs. Oh, and let's not forget NIKKIA, Nikkei. Japan's market, even though it's pulled back, has hit all-time highs recently as well. Interesting thing about this one, trading at 21 times forward earnings. S&P trading at 21 times forward earnings. If you think the yen is going to strengthen because the Bank of Japan is going to move off the zero line, maybe that's just, it'll be a market that outperforms the S&P. But if they don't, which I think it's going to be tough for them to do that given the level of debt and a shrinking population, is this a country that's going to want to take on the added cost of financing all that debt while the equity market is doing pretty good? Right? So I think that's going to be a tough one to do. I don't know that I'd be 50-50 on that one right now. Also fueling the Nikkei, buybacks in 2023, 3.1% growth in buybacks over 2022, 65 billion. The expectation is for those buybacks to continue. That is something like more than half of the total free cash flow of all the companies in the 225. In the index itself, more than half of the cash flow. That's 65 billion. Let's look at NVIDIA. What can we do here? By some measures, it's a really expensive stock. By other measures, it's not. And it comes down to a simple hypothesis that you may have. If you look at its PEG ratio, we look at its multiple of earnings, about 36, somewhere between 36 and 40, depending on the estimates you use to get the forward multiple, but with growth that is significantly higher than that. So we'll just put a number X, with X being greater than that, which gives you a PEG ratio of less than 1. It's hard to find a PEG ratio of less than 1 anywhere. So if we're thinking about GARP, G-A-R-P, growth at a reasonable price, NVIDIA is growth at a reasonable price. The hypothesis is this. Is this a build-out, a frenetic build-out of infrastructure in the AI space for the next 5-6 quarters, and then it's over, and perhaps subject to overcapacity? Or is this a fundamental change in the way computing will be done going forward, and this is a 10-year build-out? That's what it revolves around. If you think this is a couple of quarter build-out, this is not GARP. This is momentum, pure and simple. You're a momentum trader. If you think it is more long-term, well, then you can be a GARP investor in this one, and you can say, look, I don't mind holding this for a couple of years because this is a 5, 6, 7, 8, 9-year build-out. I don't know what it is. My thinking is that at some point you will hit saturation where, okay, we've got enough GPUs out there. All of these startups that are being financed right now, many of them will go away, but they're fueling the purchase of these GPUs. And I think you're going to hit a period of overcapacity much sooner than later, which means I think this is purely a momentum play. But still, no matter what you think, that means it's in play for as long as markets are going up. This thing is in play. Let's look at some options here. 41 days to expiration, puts 20 delta is a 765 strike for 1775. It's after hours at 8:51, closes 875. 110 to the downside, 1775, which gives you a break even somewhere around $748. Would you want to own it at seven? You got to ask, would I own it at 750, right? A 30 delta, if you want to get more aggressive, the strike is 810, it pays 34.10, gives you a 775 break even. 20 delta call, 1080, 1935. Can it regain the 965 and then power on another 120, 130 bucks to 1080? And if you think, well, no, it can breach 1100 in the next 41 days, then there's where you want to be. 30 delta call, which is closer, has a strike of $1,031. So it just has to get above 1,030 by that point. If you think, well, yeah, I think it can do this, then you should be very comfortable selling the puts as well. So perhaps risk reversals are something you want to look at. The 20 delta risk reversal. Risk reversal means you're going to sell the put and you're going to get 1775, and that will fund your purchase of the 20 delta call, which is 1935. It'll cost you 160 bucks to get that done. Plus, you'll need margin for the put, right? You'll get to calculate what margin you'll need, and this is not a cheap stock. So your margin for small accounts might not be something that you can get done. 30 delta risk reversal would have higher margin because it has a higher strike, but you'll get 34.10 by selling the put, and you'll finance the call at 30.90. You get a credit, you get paid 320 to get that done. I think if I were a momentum trader, I probably would be playing the 30 delta put at 34.10 easily. I would be doing that. I don't know that I would. I don't know about a risk reversal. I think most momentum traders want to be net long, which means either buy as many shares as they can, 5, 6, 7 shares, whatever they can trade in their small accounts, and buy calls, shorter dated calls, which are cheaper. Buying calls forces the market maker to have to buy the underlying because the market maker would be short the calls, and on a net basis, if there's more call buying than put put selling, the market maker would have to buy the underlying stock, so that you are actually contributing by buying shorter dated calls on a momentum play. You're actually contributing to the upward movement in the underlying, which helps you out. But there are some thoughts of what we can do if we were looking at 41 days to expiration. This is still a momentum stock. I don't know if it's a GARP stock, but it is a momentum stock. Or you could just say, I want to sleep well at night. I don't want to really try that hard. There's lots of opportunities in the market to make money. Look at AT&T. You may think, AT&T, come on. It's not going anywhere. And you're absolutely right. It's not going anywhere, which is why it's such a great stock for an income play. 6.5% dividend yield. Here's a 3-month chart with a line at $17, below 17, above, below, above, below, above. I mean, that's kind of an attractor point for it. Based on its last 10K, it's got a focus on paying down debt. That's good. Its joint venture with BlackRock for the rollout of fiber lowers the capex that AT&T would naturally have to do. That's good. Its move to an open RAN, an O-RAN system and software-driven network will lower its capex expense as well, and its focus on 5G and fiber is forward-looking. So I argue, based on that, it is well supported at $17, especially given a 6.5% dividend yield. Well supported at 17. 41 day to expiration, $17 puts 47 cents. That is the put. That is 2.76%. Based on the price of the stock, and the call is 59 cents, 3.48% based on the price of the stock. So I would sell 17 puts if they're put to me. Basically, I'll pay 17 minus 47 cents. I'll pay 16.53, which is down here. Just a couple of times it's been below there, but mostly held up above there. I'll get the 6.5% and I'll sell the 17 calls against the stock that is put to me. And as long as it goes in that sideways channel, I can do probably 20% a year just on puts and calls, 2.76% per month for every month, or in around 2 to 2.5 to 3% a month on puts as it hugs around 17. 3.5% on calls if I own it, plus the 6.5% dividend yield. You don't have to chase these dangerous stocks that can crush you in a day. You can play nice boring stocks like this and still do fairly well. You can play nice boring stocks like Oxy and still do fairly well. Every stock has a story, and some stories are low risk with nice high return if you know how to use the options. NVIDIA, big payoffs if you get it right. But big crushing losses if you get it wrong. It's the kind of stock that if you are not careful can wipe you out in a day. How many people were wiped out in this particular day? Now, the reason it fell so fast in such a short period of time is momentum traders play with tight stops. So it triggers some stops, which triggers selling, which hits the next pocket of stops, and it just keeps triggering more and more selling because you keep hitting all the stop losses all the way down. And eventually you get to a point where you've triggered all the stops. So momentum traders will push a stock up for you, but keep in mind they're the first to bail because they play with tight stops, which means if you get a small little pullback and it hits a pocket of stop loss orders, that will create more selling and push it down, which will hit the next pocket of stop loss orders, and you can get this cascading effect that can move faster than you can think. That's what you got to be worried about. Great crowd to have behind you to push the price up, but they're not going to back you up in a fight. They will run as soon as the big guy comes out, right? So they're not really your friends. But if on Monday you start seeing some upward, let me clear up something. Let me show you a chart pattern that you could look at, that you know that they're back in. Because momentum has a very clear footprint. So let's just do an intraday. So the price starts and it does this kind of thing, right? You'll have this kind of thing where it gets bought up. It's making a series in intraday of higher lows. And if it breaks this high, it will go on to the next one. Day traders, the momentum traders, a lot of technical stuff in there, but it's usually just a lot of this kind of stuff here. Once you start seeing this pattern in for the day, the Momo crowd is in there, which means, on a pullback like this, if you see it break the last high at here, to have a safe purchase, you can buy here, because it might fail here. And if it fails, it'll do this kind of thing very quickly. But if it breaks the last high, this is usually where a lot of purchase orders are sitting. So when it hits here, it does have that move up, because you have confirmation that you have a new intraday high, and that is where they sit. And because all the orders are here, it hits a pocket of buy orders and up it goes. Okay, SPY, March 7th, hit another all-time high, closing, that is, not intraday, but closing of 514.91. The highest intraday print for SPY was pretty much near the open on Friday morning, and then down it went. Sitting at 511.64 is just slightly down from the week before, but down below the 514.91 for another all-time high, March 7th. Forward four-quarter operating earnings, still all of 2024 in here. 243.29 up from 243.23. 240.81 up from 270. 240.74 again. Hardly. You can call that the same. Closing SPX 51.23 gives us a 21.168 multiple, down from 21.229. Being that, what do you got, 6 cents here, you got 7 cents here. Being that it's such a small amount, there's not a lot in the change in the multiple that we can attribute to change in earnings. It's almost 100% multiple contraction from 21.23 to 21.17. Again, not much. Surprise factors moved up to 6.3 from 6.2. So if we adjust the PE by the surprise, if we can repeat the Q4 surprise in Q1 through Q4 of 2025, then we're really sitting at 19.91 times the forward multiple. Last week it was 19.99, so 21.168. Japan is sitting pretty much at the same number. But our action on Friday, look what it did to implied volatility for 13-week, 97%, up from 35, 68 on 26, up from 23, and 52, up from 13. And we've already talked about NVIDIA, 875.28. After hours, 851. Week over week, that's still a gain of almost $50, even after that devastating Friday. It's on a weekly closing basis, it's still up another $50. So for momentum traders that play on a weekly chart, it's still momentum, it's still there. Even after hours, even with the fall after hours, week over week, NVIDIA is still up 24.50. So it hasn't broken its cycle yet. Market cap 2.19 trillion, added another $120 billion. So there it is. That's it's a roller coaster. It's going to be a hard thing to play. Bitcoin's going to be a hard thing to play. Gold's going to be a hard thing to play because what's sitting above it? You know, you're pretty much at all-time highs or slightly below all-time highs. You have air pockets above you. You have stretched valuations. There is no doubt that you have stretched valuations, but you also have a narrative of rates coming down throughout the year, which will add liquidity to the market. I don't know. I'm still at that level of maximum indecision. However, I do know that Oxy is a beautiful thing to play. I do know AT&T is probably going to be a very nice thing for me this year. GM, I think, is a good one to sell puts on because they're not going to get respect from the market, which means they will continue to buy back their stock. I believe they're fixed their EV problems. The the EV Blazer is back on the market with a price cut so that it can also get the $7,500 EV credit. So it is now some $13,000, $14,000 lower because of the price cut and the tax credit, but still way more expensive than the internal combustion. However, they're still in that. They're still in there, so I think it's worth selling puts on GM. Although I don't see them being a winner unless they change their management at this point. It's management that's the problem. So unless they change the CEO, I don't see them being a winner. I think their price is going to be a function of the aggressiveness of their stock buybacks. They've done a 10 billion accelerated buyback because there is no other way to get the price up. I think they'll do it again. NVIDIA, Bitcoin, gold, you play that at your own risk. That's got the momentum crowd in there, and they're like deer, right? They will run the moment they sense trouble and leave you holding the bag. So you better learn to run just as fast as them. And that's it for this week.